Hello everyone, welcome back to our Accounting 210. In this video, we continue with the chapter 10, performance evaluation. And finally, we will really start working on some important part. Okay, so last time we talked about learning objective 1, basically just the background. Learning objective 2 give you some idea about the variance. And then today we talk about the important part. How do we evaluate the performance using some ratios, right? Using some calculation. So now let's get started. Okay, I make this a little bit larger so you can see it. Okay. Our focus is on the investment center. I hope you still remember what's the meaning of investment center. So it will be evaluated based on what? Based on cost, revenue, profit, and then investment, right? And then how do we evaluate them? We said we can compare their performance based on their budget, but we can also compare each investment center with their peers. So use your textbook example. We look at these two investment center. One is the beverage center. One is the Frito-Lay, the snack center. Right? One is the beverage center. One is the snack center. And then we want to say which center is doing better than the other one. We have the operating income, we have the assets, we have the sales revenue. So if I ask you, hey, you are the boss, you are the big brother, big sister now, and then I'll give you this data. You look at this one, you tell me which one is doing better. I would say if we just focus on income, then it seems this one is better, right? It seems this one, the absolute number, that is better. But how do we use this fancy calculation and then have a better evaluation? We first want to use one thing called return on investment, ROI. Very important, very common in our accounting field. It's basically is your return divided by your investment. So why we cannot just look at the income? Because we think it's not right to compare orange with apple. So you can see they have a different assets. The beverage definitely is much bigger than the snack, and then even the sales revenue is higher. So you cannot just look at the absolute number. We have to scale them. So you can compare orange with orange or apple with apple. You cannot compare apple with orange. Got it? You cannot compare your small business with Google, right? You have to scale based on your assets, or based on the size, based on those things. So return on investment basically is your return divided by your investment. In our accounting, or at least in this class, if something on something, right? Like A on B, that means is A scaled by B. So return on investment is your return divided by your investment. If we don't see anything special, the return will be your income, and the investment will be your assets, will be your total assets. So ROI will equal to income divided by assets. Your first job is you need to know this formula, and then you get the ratio. So for our beverage, right? So for our beverage, the ROI will be income is 2785 divided by total assets 28128. So from your textbook, we can see we got the ratio is 9.9%. And then our snack, we said the ROI equals to income 4304 divided by the assets 5375. We get the number is, oh my goodness, big number, right? 80.1%. So you can see definitely your snack is much better than the beverage. So given the same assets, your snack generates higher income than the beverage. So snack is doing better than the beverage because it has a higher return on investment. You want this number to be higher. That means given the same assets, the center generated more income. The center generated more income. Okay, so make sure you know the meaning, you know the definition, you know how to calculate, you know how to interpret. So given the same, give you $1, okay? Hey, listen to me. Give you $1 of the assets. The beverage center will generate 9.9%. How much that will be? Give you $1. It will be 9 cents, 9.9 cents. Okay, so for $1 of asset, beverage center will generate 9.9 cents as the income. But for snack, give $1, snack center will generate 80.1 cents as the income. So for $1 of the assets, definitely snack is doing better than the beverage. Ah, got it, right? Got it. Okay, so next one, we break it down to two different parts. One is sales margin, one is capital turnover. So now you do the same thing, but you have to do these two ratios kind of. So the sales margin basically is how well you generate your income based on $1 of the revenue. Okay, so when you sell $1, how much is the operating income? So our sales margin will be your operating income divided by sales. When your sales increase by $1, how much your operating income will increase? Kind of like contribution margin, kind of like those things, right? Kind of like that. So it's your operating income divided by your sales margin. So our beverage, the sales margin will be operating income divided by sales. I'll make it a little bit smaller so we can see all the number there. Okay, I hope you can still see it. I'll use a different color of the pen. Okay, so let's get another color. How about blue? The beverage sales margin is operating income. Beverage is 2,785 divided by sales 2618. So gives me it's 13.5. It's 13.5%. What does this mean? For $1 of the revenue, your operating income will increase by 13.5%. For $1 of the revenue, it generates 13.5 cents as the operating income. And then for our snack, our sales margin will be operating income 4,304 divided by the sales 14,782 gives me a percentage of 29.1%. The winner is still the snack department, the snack center. That means for $1 of the sales revenue, your operating income will increase by 29.1 cents. Okay, so this is sales margin. Next one is capital turnover. I change another color. Next one is capital turnover. So what's the meaning of capital turnover? Capital turnover. So whatever the turnover means how fast your capital can turn. Generally it said how efficiently the division use the asset to generate the sales revenue. So you use the sales revenue, so your sales divided by your total assets. So for $1 increase in the assets, how will that increase your sales? We said for the beverage, the turnover is your sales. Now we focus on sales, right? 2618 divided by your assets, 28128 gives you 0.73, and then for our snack is your sales 14,782 divided by your assets 5375 equals 2.75. The winner is still your snack. What does that mean? For $1 of your assets, your sales revenue will increase by 73 cents for beverage center. But for $1 of the assets, your sales will increase by $2.75 in Snap Center. So your job is to know ROI, sales margin, capital turnover, definition, right? The formula, how do you calculate, and then how do you interpret? And we want definitely for all three of these, higher means better. ROI higher means that you can generate more income based on the assets. Sales margin higher means that for the same sales, that center has more operating income. Capital turnover means that for $1 of the asset, that center will generate more sales. Okay, I think I'll stop here. But your textbook, okay, your textbook, I'll put it here, I'll put this side. Your textbook also mentioned, this is just the extra. I'm not sure whether you have this in the My Accounting Lab, yes or no, but I want to share with you. I think it's a very good point. Your textbook said actually your ROI equals your income, operating income divided by assets. But this can also actually equals to your operating income divided by sales, and then time the sales divided by assets, and then you cancel the sales, right? So if you cancel the sales, it's still operating income divided by assets. But operating income divided by sales, this gives you sales margin, and then the second part gives you the capital turnover. So what does that mean? Basically, it means your ROI equals to sales margin time the asset, the capital turnover. Okay, so whenever the question gives you any all the variable and ask you to calculate the third one, you should be able to get it. So ROI equals to operating income divided by your assets, right? And then margin, sales margin is your operating income divided by your sales. And capital turnover is the sales divided by your assets. One more time, this sales can cancel with that sales. So whenever you have this information, you have possible way. I will make another video, for My Accounting Lab for more practice. But whenever you get all like the numbers, you should be able to get the missing number. Okay, so how do you combine those three measures together? ROI equals to sales margin time and the capital turnover. Okay, then I stop here. I think this part, yeah, you have some numbers, but the logic is straightforward. You practice some questions, you will be fine with this part. Next time, we talk about the third measure called residual income. I see you in the next video. Thank you.